Have you ever noticed that right before a housing market crash, everything feels completely normal, even safe? Prices are up, homes are selling, headlines are calm, but beneath the surface, there is warning signs most people miss. And that's exactly what I want to show you today. I'm Justin Chausse of the Chausse Mortgage Group, and if you're buying and selling or even just watching the real estate market closely, this video could save you a lot of stress and a lot of money. I'm breaking down what always happens before a market crash, the subtle indicators most people ignore, and how you can protect yourself before it's too late. No fear tactics, just real insight from someone who studies this stuff every single day. So let's talk about what actually moves the market. 3 core drivers that quietly shape everything: interest rate, wages, and consumer confidence. If you understand these, you'll see a pattern that comes before every correction. So let's dive in. Take interest rates. When they drop, people feel more comfortable buying. Monthly payments go down, and suddenly more buyers flood the market. That demand drives up prices, and fewer people are willing to sell. Because why would they? They've locked into a great rate, and when interest rates rise, demand cools quickly. Supply increases because people start worrying they might miss their chance to sell. It's a delicate balance, and it shifts fast. Next is wages. If wages fall or even just stagnate while everything else gets more expensive, buyers can't keep up. That's when more homes come on the market. Not because people want to move, but because they have to. Falling wages usually signal broader economic trouble, and that fear causes demand to drop even more. People pause, they wait, they watch. And then there's consumer confidence. This is always the last domino to fall, but once it does, everything moves quickly. We saw it in 2008, we saw it during the early days of the pandemic, and we've seen it plenty of times before. When people stop believing that the market will keep going up, they act accordingly. They list their homes, they stop buying, and the entire system starts to wobble. At first, fear gripped the market. People rushed to sell, terrified they'd lose their income, but then came the stimulus, money printing, low interest rates that changed everything. Demand exploded, people upsized, bought investment properties, converted homes into rentals and Airbnbs, inventory vanished. But go back even further, and we'll see a pattern repeat itself again. In the 1990s, inflation surged, and the Feds jacked interest rates by 17% or more, and mortgage rates became unaffordable. Housing activity slowed to a crawl. Then came the savings and loan crisis. Risky lending, deregulation, and collapse of financial institutions led to another recession. Then 2008. This one most of us remember vividly. Subprime loans, belief that prices would always rise, and an over-leveraged market caused a global financial meltdown. Prices fell hard, people lost their homes, and the impact lasted for years. Then came the pandemic boom. Rates dropped, people rushed in, and prices soared. But as rates climbed back up, markets cooled. We saw some areas lose 20% or more of the home values. Again, same pattern, only the cause shifted. Consumer sentiment, policy changes, interest rates, but the outcome is always the same. So what can we actually use to tell if a crash is coming? Well, one popular metric is the price to income or price to rent ratio. If homes cost more than 5 times the average income, some say they're overvalued. But that metric, it's not perfect. A better one is mortgage debt service ratio. How much of someone's monthly income goes towards paying their mortgage? Here's where it gets interesting. If interest rates go down, affordability goes up, even if prices rise. There's a general rule we use: for every 1% drop in interest rate increases affordability by roughly 10%. So naturally, prices rise with affordability boosts. But when rates rise, the affordability drops, and that thing starts to tighten up fast. And when those mortgage debt service ratios are too high, when people are using too much of their income just to cover their mortgage, that's when prices start to fall. It's not just about what the home costs, it's about what it's costing you month to month to keep it. Another warning sign: rapid price growth. If home prices are jumping by 10, 15, 20% a year while wages stay flat, something's gotta give. A disconnect leads to affordability crisis. And when people can't afford their homes, demand shrinks. And I'll say it again, the biggest red flag in my opinion is risky lending. When the bank starts approving subprime borrowers, when you see those no income, no job, no asset loans reappear, or when more people are using adjustable rate mortgages, they're all signs that the market is stretching beyond what's healthy. This is what triggered the 2008 crash. People weren't able to keep up with the rising mortgage payments, delinquency spiked, and the rest is history. When too many people can't afford their homes, it starts to happen all at once. That's when the market corrects hard. And this isn't just a theory. It's played out the same way time after time. Loose lending, overconfidence, and a big run up on prices, and then the inevitable correction. What changes each time is what starts the chain reaction. But once it starts, it's hard to stop. The other thing that we need to keep in mind is that housing markets are local. The national average might say one thing, but every city has its own story. And some places are booming while others are softening. Local economies, job growth, migration trends, all of these matter. For example, during an oil boom, places like Alberta thrive. During oil busts, they don't. When one province gets too expensive, people move out. It shifts demands. That would really drive real estate trends, where people are going, what they can afford, and how confident they are in their future. Now let's talk about inventory. A lot of people think high inventory means a crash is coming. And while that can be true, inventory is a lagging indicator. Builders respond to market confidence that exists a year or two ago. If the market shifts while they're building, you can suddenly have too much supply. And if builders disappear because of economic uncertainty and those builders sit on the market, prices soften. Sellers lose leverage, and in some markets, it snowballs into major corrections. So what can you do? My advice is simple. Always buy within your means. Don't stretch your budget thinking prices will keep rising. Give yourself room for the unexpected. Avoid speculative buys. The worst time to invest is when everyone else is rushing in. Instead, wait for value. Buy properties that will hold up even if the market dips. Ask yourself, if your income drops by 20%, could you still afford your home? Or if not, maybe it's time to reassess. In Canada, most people have 5-year fixed rate mortgages, which is really like a short-term adjustable rate mortgages. Well, in the US, people can buy 30-year fixed rate mortgages, which means more predictability. Build an emergency fund, cut down on high interest debt, protect your credit score, and most importantly, diversify. Don't put every dollar you have into your house. Make sure you've got other investments, stock, bonds, and cash. That way you can weather different kinds of storms that may come up. Because at the end of the day, this business has taught me something really important. You can't predict the future, but we can prepare for it. And being prepared, that's what turns a downturn into opportunity. So be smart, be conservative, and always keep your financial plan rooted in reality, not just hope. That's how to avoid a crash, or at least how to survive it. I'm Justin Chausse with the Chausse Mortgage Group. Thanks for listening. And if you got any questions about where the market is headed or what makes sense for your financial situation, please reach out anytime with the booking link in the description to book a call with myself and my team.